And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith, good afternoon.
Good afternoon.
You're looking very laid back right there.
Well, we're coming off the back of a holiday, so you're guilty.
Well, you've had a little holiday, but look, I see the viewers can't view you because I can't see the cameras. The cameras are not here today.
No.
But normally we would video the episode so that you could post it on YouTube later
Correct.
on. But today there's no camera, so you're just leaning back in the chair like it's a lounge chair. I think I feel like I should offer you a cocktail.
You know, if there was a bar fridge in here, we might have to fix that. We can make this show really exciting on a Friday afternoon.
well, okay, we'll take that on advisement, and we'll see what we can arrange for future episodes.
Say less.
Today, we're talking about the markets, which have been trading at pretty high levels lately, despite the fact that today's share market has actually fallen just by the barest of margins, 0.01% for the All Ordinaries.
That's smidge.
That's hardly worth mentioning.
Correct.
But we are near record highs, aren't we, in
100%.
the share market, and certainly in the United States, the share markets there are pretty robust as well, aren't they?
Oh, look, very much so. It's very difficult to find really good value at the moment without taking significant risks. But that sort of brings us to a point where I think people miss opportunities to lock in gains. And today we're just going to touch on what to think about and why you might think about it and ways to then mitigate capital gains tax, should that be an issue, depending on what it is that you're going to take out of a portfolio. Because everybody loves when markets go up and everybody loves seeing the value climb. And we need to keep in mind that an average return is exactly that, an average. So we're going to have great, we're going to have bad. And, you know, I love the saying that nobody went broke taking profit. And I think the one thing that I find a lot of the retail investors miss is that if you have a set and forget mentality, or you have a high concentration of specific assets, you can actually accumulate a significant overexposure to growth assets in a portfolio. Because if you have a diversified portfolio in place, and let's say you had 70% growth assets and 30% defensive, right? Which for most industry fund is balanced, which we all know is not balanced. But 30% of your portfolio in cash and fixed interest does not benefit from capital growth. So if you've got 70% of your portfolio growing significantly, and most international ETFs at the moment are providing really, really strong double-digit numbers, 20+%. Now, that's bonkers. Those sorts of numbers on an annualised basis are bonkers. So you want to be thinking about looking at your portfolio and saying, well, how much growth am I actually carrying now? Because you might have had 70, 30, 12 months ago. You could be at 80, 85% now and carrying far more risk than you realise. And it would only take a few out-of-the-box events and some adverse news or individual company reporting to see large swings in value. And we've seen that with the likes of CSL. We've seen really big swings in value. On the other side, we've seen CBA be overvalued to Kingdom Come for quite a long time, and we started to see that pull back from record highs as well. So I guess people should also keep in mind that it's a great time to be looking at how much of an individual asset does something make up of my portfolio, and then think to themselves, well, if this fell, what would it do to the total value of my net worth or the income that I receive, and look to take some profit. Now, I'm not saying sell out of something. I'm just saying, would it be prudent to sell 20, 25% of a holding to then reallocate into something that may offer greater short to medium term value, or to increase the fixed interest part of the portfolio to rebalance the seesaw, if you wish, because one end's got a little bit too high and we need to just slide some of our asset allocation to the other end just to balance it up. And I think a lot of retail investors don't do that, but then wish they had if a market corrects itself. And I guess we're just pointing out the importance of doing that, and to keep in mind that, everything that goes up must come down.
Well, sometimes it does and sometimes it doesn't seem to. But anyway, the question at the top of the page is, should I be taking profit? But I guess that really depends on a number of factors, doesn't it? First of all, if you do sell off some of your holdings, what's your plan for those funds? Where are you going to put them next?
Yep.
in order to maximise your return?
Yep.
Or are you better off just leaving it where it is? There are a lot of things to consider, aren't there?
That's right, and that's where you need to look at this on an individual asset basis, especially where people have ETFs and listed shares, and you can really isolate, well, what did I pay for it? You know, if you're holding CBA and you paid, you know, a very reasonable entry price, again, I'm not saying race out and sell stuff by any stretch, right? Because good quality assets are good quality assets. It doesn't matter what they have in the way of their return. But you need to look at each asset in the portfolio and say, why have I got it? What is it doing for me? And traditionally, people have held bank stocks and the likes of a Telstra for income. Now, if you've bought CBA in the last 12 months, the income you're getting off it is horrible when you look at the yield by taking the distributable income and dividing it into the share price. You're probably getting less than the cash rate. Now, if you bought that at $60, $70, $80, you're getting an amazing income stream because you've had the benefit of time. But if you took some of that portfolio and took some profit and bought some more fixed interest assets, you could actually probably get a similar or commensurate level of income and de-risk the portfolio in light of the fact that we are trading at unseen levels. Both, you know, we've been over 9,000 points on the ASX 200,
yep,
and the US is over 4,700 point, 47,000. It's mental.
Yes.
You know what I mean? Like, no one ever got upset about going, oh, I took some heat off the table and I'll reallocate it into something else. Oh, there's a correction. Great. Buy back what you sold. And this is where people shoot themselves in the foot, because they go, well, if I sell it, I'm out. Well, if you sold some, you're still exposed. If you've got 5, 6, 7, 8, 10% of the stock in your portfolio, I think you're mad. As a general rule, from a risk mitigation perspective, I've never run more than 4 or 5% in an individual stock in a portfolio ever. And my logic for that is that if something blew up and you've got a 4% yield coming out of your portfolio, you've got 1 year's income at risk. If you've held stuff for forever and have massive overexposures and you don't want to mitigate the tax to sell them, then okay, hold them, but make sure you're diversifying into other areas. If you do sell and you realise a capital gain, then think about the use of that money. Am I putting that money into super to maximise my deductions? Am I using the catch-up concessional legislation to maximise my deductions? Am I selling other assets you may have that have losses in place at the same time as a gain to net off a gain and a loss to reduce the tax implications? Am I selling 2 allocations of a holding, some before June and some in July, over 2 financial years? So be strategic about how you manage taking profit. I'm not saying race out and just sell stuff willy-nilly, but you've always got to look at, why do I hold that asset? What does it do for me? And if I'm going to reduce the exposure and take profit because I want to pay for a holiday, I want to buy a car, I want to do something, do it strategically over time and use those strategies that are available to you.
Now, you've already touched on this, but I was thinking of asking about what I think is a clear question here. If I've been holding those hypothetical Commonwealth Bank shares since I bought them at $50 and now they're over $150, if I sell them, there's going to be a capital gain and I'm going to have to pay tax on that, aren't I?
Yeah, that's exactly right. And again, that's why I'm saying don't just race out and sell stuff willy-nilly, but think about what you have at your fingertips to be able to reduce the impact of that tax impost. You might sell stuff over 2 financial years. You might wait until you're in pension phase to do that. So if you sell assets in a pension, you pay no capital gains tax. So if you're approaching retirement, you might leave assets in place and then sell in pension phase and pay no capital gains tax. That would be very, very sensible. But you then want to be thinking about, if this asset is a significant portion of my total wealth, do I need a dividend reinvestment plan that's in place, buying more shares in something I already have an overexposure to? You might say, well, no, I'll take dividends from that now and then reallocate to manage your asset allocation and to diversify your risk. So think about what you're going to do. All we're trying to raise today is taking profit is not a bad thing. And I've never met anybody or dealt with anybody that was upset about selling at record highs to then be able to buy on future dips. And everybody talks about, oh, Trump said this and, you know, it dropped this much in this day and I bought some. Great. If you're cashed up because you've taken profit and you can buy on a dip, wonderful. You make even more money because this is a long-term play. So it's about having the cash available to buy on weakness should certain events occur in the future, or taking advantage of ad hoc news, market noise, whatever it may be, and having the cash there to be able to buy some other stuff. I'm not saying sell and stay out, but if you're cashed up and ready to pounce, there's money to be made. People don't do a lot of profit taking. They just go, well, I'll hold it forever, I won't sell. But then they get upset on the flip side if a COVID-like event occurs and the value of their portfolio drops. That starts to then influence decision-making, like, do I retire, do I not retire? Can I fund my retirement, can I not? And I think people need to try and divest themselves of overexposures and just continue to be prudent from an asset allocation perspective.
I guess it's also handy to make sure there is a cash reserve so that if there is an unexpected event like a COVID or whatever, then you can take advantage of opportunities that might arise.
100%. And I would say to people, if you're in pension phase, I would highly recommend 12 to 18 months of living money in cash, because you've future-proofed your cash flow for an extended period of time. And if you think about a COVID-like event, if you've got 12 to 18 months of living money in cash that you could get to and it's not invested or it's in fixed interest and you could limit the volatility of its value, COVID came and went inside 12 months from a valuation standpoint, yet in the throes of it, people were freaking out because we saw a very, very quick fall in value. We then saw a commensurate rally in the price of things. But I saw it affect people emotionally, because it then made them question the suitability of their asset base and their ability to fund themselves in retirement. And people were coming in with the planned retirement, then being influenced by the emotion of what they were going through and not taking a longer term view. They were very much caught up in the short term noise. So it's about understanding that you have a very resilient portfolio that can handle both good and bad times, and selling now at record levels is never a bad thing. And if you've got to pay a little bit of tax, as I say to most people, all right, we'll pay it. Or better still, I'll buy it off you at a price that you bought it at so that you don't have to pay some tax. And they laugh in my face. I said, all right, well, just zip it up and pay the tax. But be strategic about how you manage it.
Luke Smith from Envision Financial is with me in the studio this afternoon. We're asking the question, with markets trading at crazy levels, should I be taking a profit? We're talking about the share market at the moment. It's at a pretty high level both here and elsewhere in the world. So is it a good time to be selling some holdings to take a profit? So what are the key strategy tips when it comes to taking a profit and locking in gains that you might have made?
Yeah, well, I think firstly you've got to look at assets and say, well, what have I got and why have I got them? And if you have, as a result of growth, got an overexposure to something, it may be prudent to lighten that off and then reallocate into other assets from a diversity standpoint, which is wonderful. You can also then look at the income that you're getting from the asset or other alternatives to try and maintain a suitable asset allocation. And if that means you go into some active fixed interest and get a 4, 5, 6% yield, great, no problems. Nobody got upset about getting a regular income stream that is better than cash, and there's loads of ways to do that. I think you need to think about how you would feel if markets pulled back very quickly. I know that when we saw a pullback over the tariffs a number of months ago, a lot of people really freaked out by that, because we've had an extended period of time of very, very good numbers and very, very good returns, and people become very complacent to what is normal. And I think we're just pointing out today that normal can be good, normal can be bad, and recency bias raises its head, and if all you've ever had is good returns and you haven't had a really good belting in quite a while, one's coming. So taking some pressure out of some assets is great. There's loads of ways to manage the tax. You can make super contributions. You can use catch-up concessional legislation. You could wait and start a pension. If you're over 65, start a pension. If you haven't, sell it with no capital gains tax in pension phase. There's loads of ways to try and mitigate the tax. But just remember, how would I feel if things pulled back? Would I be happy that I took some profit? And when I say take profit, I'm not saying sell everything. I'm saying if we have a large exposure to an individual asset, you might sell 20, 25% of that holding, reduce the weighting, hold some cash, and if things dip, buy back into it. If you believe in the philosophy of what you hold, nobody got upset about buying something at a cheaper price. CSL's...
Just ask Kerry Packer.
Well, exactly. And, CSL's a great example. There's a very high quality stock that's had some very large swings in value this year. Now, does it mean it's a bad company? Not at all. Could we have bought things along the journey at a significant discount to trading values throughout the last 12 months? 100%. So it's not about, people seem to tie the word sell to bad, and it's not about that. It's about understanding the diversity of your portfolio, the income stream and tax credits that you're controlling, and then mitigating risk if we were to see large swings either up or down. Because if a large portion of your portfolio is growing and part of it isn't, you're maintaining a much higher allocation to growth assets. And I use the analogy all the time. If the speed limit's 100 and you just keep your foot on the gas and all of a sudden you're doing 140 in a 100 zone, you can't get upset about getting a ticket. So if you are worried about that sort of stuff, just slow the car down a little bit by taking some profit and buying some more fixed interest. It's something that a lot of retail investors don't do because the word tax frightens them. But I can assure you, the tax you will pay will generally be far less than the fall in value if there's a correction, depending on the weighting you have to some individual holdings. So just be mindful of how you would feel if the market pulled back, and be proactive now, because if you go, I sold it at the top, wow, who cares what the value is? You can always buy in later, but you've got control over your destiny, you've got control over your income, you've got control over your asset allocation, and you've used strategies to mitigate tax where you can. And I think that's how you can maintain some very, very good consistent returns over the medium to longer term.
Well, look, it's time for me to ask, where can listeners get more information?
Yeah, office number 6260-4749, envisionfinancial.com.au, the Strategy Stacker podcast on iTunes and Spotify, and we've got Envision Financial Canberra on YouTube. And to wrap that up, we have a position available. So if you'd like to apply, call the office, 626-04749, and send through your details, as we've got room for a new team member. Availability immediate.
Fantastic. Thanks very much, Luke, and we'll catch you again next week.
See you next week.
Luke Smith from Envision Financial, back in the studio here at Radio 2CC at the same time next Friday afternoon between 4:30 and 5.